some insight. No pressure. I'm counting. The first tax presentation, so to speak, comes from Johannes Edlbacher, partner, financial services tax at PwC Austria, with deep expertise in international taxation and how instruments like CARF will reshape investor obligations. So please give him a warm applause. Say hello.
Yeah, so thanks for the introduction. In the next 10 minutes, I will give a short overview on the crypto asset reporting framework, or called CARF. Let's acquire the important topic currently because it will become effective next year. So 2026 with the first reporting in 2027. So what's the background of that? So when we have crypto investors, then of course they are obliged to tax their income or whatever, including my tax return and tax it correctly. But the problem here is that the tax authorities, they have no insights in my crypto trades and in my crypto holdings. And this is why we are faced with quite a lot of crypto tax non-compliance. So a study was made in Denmark, and it shows that more than 90% of crypto investors currently do not tax their income from crypto assets correctly. And that should be solved by the crypto asset reporting framework, which is a reporting, tax reporting guideline. And based on this CARF, crypto exchanges, for example, are then obliged to make specific reportings to tax authorities to guarantee that the investors actually tax their income for crypto assets. CARF is not quite new, so we already have the common reporting standards. Common reporting standard is quite the same as CARF, but not for crypto assets, but for traditional financial assets. So under the common reporting standards, financial institutions are obliged to report cross-border transactions or cross-border exchanges or on income from traditional financial assets to tax authorities. And the common reporting standard was a role model for CARF, and CARF is more or less the same, but for crypto assets. And you can see here that it's in 2022, a first publication of the OECD CARF was published. This OECD CARF was adopted by the ECOFIN in 2023, and it was implemented into EU law with DAC 8, so it's DAC 8, which is a separate directive. And this directive has to be implemented into national law by the end of this year. And then this reporting mechanism becomes effective in 2026, with the first reporting in 2027. So let's jump to this slide here. So how does it work? So in this case, or this example here, we have a crypto investor who is resident in Germany, tax resident in Germany. And this investor makes all the crypto trades via a crypto exchange, which is in Austria. And based on CARF, the Austrian crypto exchange will be obliged to report the transactions made by the German investor to the Austrian tax authority. And the Austrian tax authority will then forward this information to the German tax authority. So in the end, the German tax authority knows that this investor here has made crypto trades in an Austrian crypto exchange. And in the end, this investor here is obliged to assess the income from the crypto assets. You can see here on these slides that not only the member states will implement CARF, but there are also a lot of third countries that will implement CARF. So, for example, Switzerland, United Kingdom will take part, and also the United States have committed to implement CARF. That's quite interesting because the United States have not implemented CRS. They have FATCA, but not CRS, which means that the United States receive information from traditional capital assets, but they do not provide any information to other countries. But here in this case, the United States will also implement CARF, which means that also the United States will then report information on crypto trades to other countries. For a reporting obligation under DAC 8, 4 conditions have to be fulfilled. So first of all, you need a reportable crypto asset. So what a crypto asset is, the definition is taken from ICAR. The second thing is you need a crypto asset service provider. So the definition of a crypto asset service provider is also taken from ICAR. Then you need a reportable transaction, which is an exchange of crypto assets against fiat or another crypto asset, cryptocurrency, or any transfer of crypto assets. So when I have my crypto assets at a crypto exchange and I transfer the crypto assets to my personal wallet, and this will also be reportable at CARF. And then in the end, you need a reportable user. And the reportable user under CARF is a person, individual person, entity that is tax resident in a EU member state. There are, of course, certain exempt persons, as for example, central banks, international organizations, and so on. The question is, what is a reportable crypto asset? So the definition of MiCA is a quite broad definition, which means that a lot of crypto assets are fall within the definition of reportable crypto assets. So you can see this as especially cryptocurrencies, utility tokens, NFTs, which can be traded on a marketplace. But that's important, what is excluded. E-money tokens are generally excluded. And the question is if security tokens or cryptocurrencies also fall within the definition of a crypto asset. In general, yes. But it can also be the case that a security token, for example, already falls within the definition of a common reporting standard and could therefore be excluded from a CARF reporting. So here on this slide, you can see the scope of the reporting. So the information that has to be reported to the tax authority for each individual. So first of all, you can see the information that is reported on the crypto assets transactions itself. So you can see here that the crypto exchange, for example, has to report the name or the type of the crypto asset itself, and then the aggregated gross amount paid, number of units, and the number of transactions for each crypto asset have to be reported in case of any purchases of sales or other transfers of crypto assets. And further, of course, the crypto exchange has to report the name, the address, the country of residence of the individual or of the entities, so that the tax authorities have all the information and can, that it can guarantee that in the end, the income from crypto assets is actually tax collected by investors. So what has to be done by the crypto asset service providers, or what are the challenges for the crypto asset service providers? First of all, they have to implement the CARF rules, which are quite complex in time. So as I said, CARF comes into force next year. So starting from 1st of January 2026, crypto exchanges are obliged to track all the transactions made by their customers or by the users. So the technical implementation can be quite challenging. The second thing is that the users of the crypto exchanges have to be identified. So a self-certification of each user has to be obtained by the crypto exchange. For existing users, this has to be done until the end of 2026. And for new users, this self-certification has to be done in course of the onboarding. So, as I said, this identification of the users and the technical implementation These are quite complex things, and of course, the crypto exchanges, they have to do this in time so that it can guarantee that starting from 2026, all these transactions can be reported correctly in the end. What is also quite important, there are in some countries could be quite high fines for non-complying of CARF or crypto exchanges. In Austria, this fine could be 200,000 euros for non-compliance. This is the same fine we have also for common reporting standard. So also in this case, cryptocurrencies have to be quite careful that they really implement these new rules correctly. So that fines are then avoided in it. Yeah, that's it. The very short overview on CARF. Yeah, thanks.
Thank you. Are there any questions? No? Okay. Thank you very much.
Discussions will follow the
Exactly. The discussions will follow on our panel. Okay. So our next speaker. Okay, I have to do two things more.